Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and deal-by-deal private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with Drew Bagin of North Haven Capital. Nicholas, what was a takeaway that you had from our conversation with Drew?
A few months ago, we had a guest on who made a persuasive argument that geography was no longer a specialty or an arbitrage. And so focusing on a geography was it was no longer an overlooked thing to do. But I think Drew provides a fresh contrarian view to that, which frankly resonates with me. So Drew is based in Portland, Maine. And anyone who has been in New England know that New Englanders, they like themselves and they like to do business with themselves. And so Drew and his partner Sam focus specifically and only on businesses that are in Maine or the adjacent states around there, so Vermont and New Hampshire and Massachusetts. And it's working for them. Maine is a small state, 600,000 people. And so when you've been doing this for a little while, you start to know all the business owners, you know the family offices who like to invest up there, and you always know everyone is a friend of a friend, basically, and especially when you're doing something as focused as lower middle market private equity. He even says that he pretty much hears about every single deal that occurs in the general middle market and down in that region before it hits the headlines. So And so why is this important? Well, I think if you have a strong reputation locally, and we've heard this from other sponsors too, it helps you with proprietary deal flow. It helps you build a connection with the seller. And all of this converts into better quality deals and a higher chance of closing them. And I think there are benefits post-closing as well. I will say, if you're based in Dallas or Los Angeles or New York, this strategy will not work for you. These places are too crowded, and being from there isn't unique enough to connect you with any given business owner. But if you're from Norway, many countries will see the same, right? If you're from Norway, if you're a business owner in Norway, someone cold calling from Germany is just not going to hit the spot versus someone who is Norwegian and follows the same soccer league and so forth. And so it really resonates with me. If you're from a smaller place, geography is something that you should embrace and be, as he says, a big fish in a small pond.
And just to follow up on your point about, we had a sponsor say that targeting secondary and tertiary markets there was no longer alpha there. If we're talking about the same conversation, I think their point was that basically the multiples used to be a little lower in those markets, and then they've since risen because capital has flowed everywhere.
Yes.
And so that, I think, is the thing that's now obsolete. The idea that you could be an outsider and go to a tertiary market and find a deal, as distinguished from what remains the case, where somebody in a smaller market is going to resonate far less with coastal private equity or somebody from Dallas coming in versus a fellow hometown boy or girl. And that seems kind of like universal across countries. We've seen this in regions in the US and likely to last. That's probably just a feature of human nature that's not going away anytime soon. It doesn't really, for the sponsors listening, there's no way you can really play this other than if you want to buy businesses where you're from or from your hometown, and that happens to be a smaller market, then great, it all aligns. But there's no way to otherwise manufacture this, because the very point is authenticity. And if authenticity is manufactured, it's not authenticity. So.
I'll bring up two more examples, and I'm not sure how politically correct this is, but when I was a searcher or sponsor, talking directly to business owners, it was always easier for me to connect with European descent business owners, meaning immigrants from the UK or somewhere on the European continent. Just naturally, we had a lot more in common, being immigrants to the United States, from Europe, following soccer and so forth. And so it helps. And you see the same thing. If you're from the same fraternity, you're going to bond a lot. And I remember once I lost an LOI in Utah, and it was stated very indirectly to me that, I was not a Mormon, so I lost out on that deal. And so this is, as you say, human nature. And one of the strongest things that bonds people together is where they live.
I thought another great segment in our conversation with Drew was how he and his partner in North Haven have acquired partly have acquired a business that is a service disabled veteran owned small business. So we see these businesses for sale. You'll see them for sale. I know searchers who have bought these businesses, but those searchers are always themselves service disabled veterans. And so the question is there a way for a sponsor to participate in these acquisitions? And we go through with Drew how he and his partner did do that. Neither of them are veterans. There's a lot of they're not a lot, but there's a few pretty stringent requirements, stipulations. As Drew said, he and his partner tried to talk to a lot of attorneys about any way that they might be able to get around those requirements or otherwise have them relaxed. And the message from legal was essentially like, don't get cute here. This is something that the government takes really seriously, which, I think we probably all agree with and applaud. But there is a way to do it. As an independent sponsor investor, I won't spoil it, but listen closely for that segment toward the end. And Drew lays out very, very clearly how you might go about this and how indeed they've gone about this in one of their deals. Max, did you have a takeaway from our conversation with Drew?
I did. And as you guys said, the local presence, the going back to kind of where you're from, I think is a great point because obviously it's a shortcut to building trust with somebody. If you, like you said, root for the same sports teams, you went to a similar high school or somebody's cousin knows somebody's friend, and that tight knit network is something you're going to encounter a lot in these smaller sort of mid-tier cities. So it's kind of interesting if you were a first-time sponsor thinking about where you're going to target. If you're from one of those towns, that's obviously a great place to start. But a lot of sponsors move around, of course, in their career and find themselves in Dallas or Houston or New York or one of these big mega cities. So there's probably some optionality there because there are cities like Houston for sure, where it doesn't really matter if you're from Houston. They've always sort of said to me here as an entrepreneur that if you can't make it in Houston, you probably can't make it anywhere as an entrepreneur because it's such an open business community. So, there's this kind of duality of it where you could go and go back to maybe where you're from and have a little bit of a leg up there, or maybe choose a more sort of business neutral, large market city like Houston or, even Dallas, I would say is probably a little less open than Houston, but still open comparatively. So that's an interesting conversation. The other point that I found intriguing, again, and we've heard this structure before from other guests, is the raising the capital up front as an independent sponsor, almost treating the independent sponsor method like a traditional search fund in some ways. So I know Drew and Sam, obviously from this episode, they raised a couple $1 million up front from some high net worth families and even a family office, it sounded like. So that enabled them to put a little bit of a team together, build some credibility, and to have a little bit of dry powder going into basically their first negotiation to make an acquisition. That's different than, of course, most independent sponsors that go find a deal and then hunt around to raise the equity after they've found the deal. And of course, I'm simplifying that. Most independent sponsors have some capital relationships before they start going to market, but it's this theme of raising some capital ahead of time. And the way they're doing that is they're effectively selling some of the GP interest, which is nice and creative. But how many people can actually accomplish that without, a track record? It's hard to say. I mean, you have to probably have a pretty good resume, even though you're a first-time sponsor, to be able to raise capital up front. They obviously did it. It sounds like it worked well for them, but you probably have to have a solid network and a solid resume and some folks that really genuinely trust you to put the cart before the horse like that. But it's an interesting structure. And I think the more we learn about the different structures that are out there, It's clear to me that there's some optionality with the independent sponsor model. And so this is definitely a version of that to consider for a new sponsor thinking about raising some capital up front to help with the process.
I mean, we always hear about all the many benefits to the independent sponsor model, but one of the weaknesses of the independent sponsor model is before you've closed your first deal, you are just hemorrhaging cash, your own living expenses, your own deal expenses, and so until you get that first deal, and even then, as we say, that first deal's management fees might just be keep the lights on money. It's hardly, it may not even be back to where you were in your W-2. So it's pretty lean and pretty tight in those early years, and so here's a way to make it a little bit less lean, less tight. There is a independent sponsor model that's a funded, as we said, a funded independent sponsor model, which is the why it's analogous to a search fund. Important point with search funds, all those investors are signing up, and they're going to get the 75% of that one deal. In Drew's case, selling a piece of the GP means that every deal that they ever do is a piece of that is going to go to the GP. So it's not inexpensive, and we talk about that with Drew. Does he reflect back that he thinks he priced it well? A model that people should look at if they've said to themselves, "I can never do the sponsor thing because I could never go a year or two without any income." Well, here's one formula you might explore. Great, guys. Well, before we turn to the interview, a reminder for the audience that here at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average about one commitment per month. So if you are a sponsor raising equity for a platform acquisition, submit your deal to us at mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, we also have a registration form on our website for investors. So if you are accredited or can become accredited, fill that form out to be kept in the loop on future raises. That, again, is at mindscapital.co. Okay, here is the Minds Capital podcast interview with Drew Bagin of North Haven Capital. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Newly acquired and PE-owned companies are high-value targets. Hackers time their attacks when teams are distracted by the deal, exactly when a breach can stall operations, bleed cash, and blow the thesis. Inzo Technologies is your full-service IT MSP for post-close stability. They assess your target, surface the biggest risks in plain English, and give you a day 1 through 30 plan to cut exposure, prevent downtime, and even find cost takeouts like bloated telecom bills. Check out inzotechnologies.com, INZO, or email CEO Nick Akers directly at nick@inzotechnologies.com. Having acquired Inzo himself, Nick understands the challenges sponsors and searchers face when transitioning a business. So make sure to tell him you're an independent sponsor and listener of the Minds Capital podcast. nick@inzotechnologies.com. Drew Bagin started his career at Lehman Brothers before spending 15 years in private equity, working at family offices, and even did angel investing as a side gig where he and his partner deployed $30 million. Drew escaped to his home state of Maine during COVID and established North Haven Capital with the help of $2 million from seed investors. 5 years and 5 platforms later, Drew and his partner attribute their success to the strong geographical focus on and near Maine, where their network brings differentiation in their value proposition as investors and as builders of the businesses they acquire. Drew Bagin, welcome to the Minds Capital podcast.
Thank you, Will. Thank you, Nicholas. It's a great introduction. I appreciate you having me on today.
Well, let's start, Drew, with this $2 million from seed investors for the GP of your independent sponsor vehicle. This is not the typical way things are done by first-time independent sponsors. So start us off by how you approached your pivot into becoming an independent sponsor and how that led to this structure.
Yeah, no, absolutely. And this is something that my partner and I, Sam, thought about for a while. And we had gotten to know each other, as you mentioned before, doing some VC stuff back in the day, angel investing. And we wanted to go in this direction, but we spoke to a lot of different independent sponsors out there that had already got up and were running. And one of the things that we wanted to avoid was rushing into our first deal, right? Because when you leave your last private equity fund, you leave whatever your last role was, that the next time you can actually pay your bills is when you close your first deal. And so we didn't want to rush into that by any means. We wanted to be patient and wait for the right one to come along. And so what we did is raise capital, from 5 high net worth family offices to really allow us to step away from our prior roles, start to build this the right way, and really be patient for our first deal. Versus, this is okay deal, but hey, it's going to start paying my bills. And that's something that we wanted to avoid. And so this type of mechanism was good because it allowed us to be patient. We gave a piece of our GP up in return for this walk around money, and it allowed us to be patient and find our first deal.
And so how do you budget how much you need to raise? Because we know traditional search funds, for instance, will raise $500,000 to fund a very modest lifestyle and some fairly moderate search expenses, but certainly no back office staff. So how would you think about, you raise $2 million? Well, what's the budget for there? How many years of runway does that give you and so forth?
Yeah, I mean, we went through this whole budgeting process too, and we did start off smaller. So when we start off smaller, like Interstate was our first investment, and it was, sub $1 million. So the management fee you can get from a company like that is, obviously not as big as something that's $2, $3, $4 million. But we did start smaller. Me and my partner, it's both 2 partners that, so you have 2 salaries to cover. But we planned on doing 1 deal a year, starting small. Management fees would start off at 150 to 200. And we were just very, very lean. We didn't really need the back office support until we got to where we are now, year 3 and 4, where we have, multiple portfolio companies and we're looking at multiple new deals. So the first couple of years, it really was just me and my partner. Didn't have rent space or anything. So the budget was pretty small. And we just went through several, just like any of your portfolio companies would do. You put that same budget together and you stick to it. And luckily, a deal per year, gave us the runway that we needed for the first 3 years, actually 4 years.
Okay, so actually the 2 million comprised of several rounds of raising capital for the GP level.
Mm-hmm.
But the initial round, was that meant to sustain you for 6 months until a first deal, or 2 years? Or what was the timeline expected when you sold it into the investors?
Yeah, it was a total of just under 2 million, and we called it over time, right? So the first was, 500,000, and then, into chunks until we got there. We had, there was an idea to only draw $1 million. And then if we didn't draw the full amount, the GP would get less of amount of ownership. So it was incentivizing us to A, get the deals done faster, and B, cost conscious.
And I would imagine these investors also had quick access or even right of first refusal to the deals that you eventually brought.
Yeah, and that's a part I forgot to mention. So yeah, that's exactly what they have going forward, is first right of refusal for any amount of capital on a deal by deal basis.
And so you said that you sold some of the GP in your company in exchange for the seed capital. So I imagine that's a minority. I don't know, 5% or 25%, probably somewhere in that range. As far as the seed capital, I would imagine also there's a mechanism that they get that back first before you guys get access to your portion of carry in the future. So there's some seniority to their ownership interests, even if they're a minority.
Yeah, we're incentivized to pay them back faster.
Oh, I see. Okay. Yeah. Yeah, no, this is cool. And it's something that we do not see very often. Do you think that is a choice that people just can't afford it or don't have access to those kind of investors, or is it a lack of track record? Perhaps you guys had that extensive finance background, so you were able to attract capital here. Why is it that we don't see it more common in independent sponsor setups?
I mean, in a way, it's kind of similar to what a search fund would do, right? But on a lower level in terms of, an amount of money. But ours were investors we had worked with over the past, 5-10 years that had an affinity for, an attachment to the Northeast. So most of the companies we're looking at are small businesses in New England, so most of them live, in the area and have a good network also to add to our companies when we invest deal by deal. And it wasn't something we put together overnight. It was basically all through the year of COVID. We kind of worked this, and I think at the end of that year, we were like, okay, I think we got to the right point. And let's make the dive.
And were you guys pro-forming a certain amount of EBITDA over a certain number of years, or even that was not super prescribed?
Yep. No, exactly. A pro forma, what the portfolio would look like deal by deal. We start off on the smaller companies. So fire protection, we started pretty small. It's a very hot space. So we couldn't get in at 1 to 2 million of EBITDA because we'd be paying 8, 9, 10 times. I mean, we've basically prescribed to them that we would, be value-based investors. Most of what multiples we pay are 5 times. And we started off small and getting bigger over time. And, a deal a year is what we projected, and now we're, the next goal is to do, 3 or 4 deals a year. That's going to probably take another 3 or 4 years to get to, and expanding the team a little bit further. But we thought that was a realistic goal. And, looking back 5 years, having a portfolio of 5 companies, it's exactly what it was. And with our last one being, the biggest deal we've done is about 3.5 of EBITDA on 4 now. So we've made that progression up into the bigger size companies, which, you can deploy more capital at, which just took some time.
And for we don't know, but the, 5 to 25% of the GP that your investors have for that initial 2 million, which was released in tranches, but call it the 2 million. Do you reflect back as that being expensive capital to have taken, or cheap? Or, just for the listeners out there who might contemplate something like this, do you think that you priced it right?
Yeah, no, I do. I looking back, I probably could have I think we could have done a little better to not take the last tranche of it. So if it was, that could have saved us another X% on the GP if we didn't. But also, sustainability was always, up front and center, sustainability of our operation. And, we didn't want to continue to keep looking at, okay, this is when it's going to run out. And so we did grab that last tranche, and it was just in time. Last year we did 2 deals in 1 year. And after that we were sustainable.
So it took you all the way until last year to actually become fully sustainable.
To actually accumulating cash versus exactly. Yes.
Yeah.
But we've also, we added back office, we added associate, we have lease space. So, as we're going, the costs are going up too. We could have, so, it's kind of a blend on kind of both of those things as to why it took so long. Doing more deals, bigger deals, but also the costs have gone up too.
Well, I think this is something to really underline here, Drew, because you guys, so just the trajectory here, 5 deals, 5 platforms in 5 years. You haven't had an exit yet, but you're looking down the barrel. Your first, it looks to be pretty good. We're about to hear about that. So from the outside looking in, it looks like you're well on your way to success, but it actually has been a 5-year or 6-year journey. And in fact, for the first 4 or 5 years, it was kind of pretty lean. And any money that you were making was going right back into building the foundation of the firm. So it wasn't quick. And in fact, you still haven't had a big exit yet, or an exit yet. So it's some of this. I might even be jumping the gun. Although, as I said, you're hoping for a really nice exit here pretty soon.
You do bring up one thing that I'd love to kind of look at differently. Is maybe take more capital and build faster. Maybe not staying so lean for 2 to 3 years. Maybe bringing on someone else. Maybe just pressing the gas just a little bit longer. Fast, earlier on.
Yeah.
But, if it was 3-4 million, then, you'd be given more in return for that. So that would be another way I would like to look at this, because maybe we would have been sustainable by year 3 in that way. I don't know.
Yeah. And were these investors of yours familiar with the independent sponsor model?
Yes.
They were.
Yeah. Some were kind of doing this on their own with their own in-house guys. And some were doing deal by deal, but it had, this part of the market was pretty familiar to them.
Nicholas, how do you respond as an independent sponsor yourself and going through, the thing that we always hear that getting your first deal done is the only way that you actually finally see some income, and even then, it's really just keep the lights on income. So those early years are tight.
And we are experiencing the same dynamic at Minds Capital. We're still only 2.5 years into our own journey, and we haven't sold any of our GP stake, but that also means we can only grow at the pace of our income streams, and they hopefully will grow over time. So I think anyone in this game is feeling that. But my guess is that you have to have a network and track record like Sam and Drew to be able to attract, because they're raising capital there for a concept, for an idea, which is very different from raising money for a deal, a tangible company under contract. And in order to be able to raise just based on an idea that may have zero value, there will never be, like, all they were buying were a piece of their time, right? And so I think that can only come from trust, or in the search fund space, it comes from a very professionalized infrastructure built around having a portfolio of searchers out there, right? And from the investor's perspective here, Drew, and I don't know if you agree, but they're putting down 200K, 400K each over the course of multiple tranches in exchange for a day-to-day partnership with 2 very strong finance guys who are going to have a local focus in their region to look at small businesses, in which these guys now have a right of first refusal to invest. And to the extent there is deals coming out and money coming out, they will have first access to both deals and then the money that is generated first. So the risk reward is not that terrible as long as they trusted you and they know that you will stay committed to this pathway.
Independent sponsors need a legal team that understands the model and knows the players. Platt Richmond, a Dallas-based boutique law firm, has deep experience in guiding independent sponsors through the complexities of their acquisitions. The team at Platt Richmond provides support on all aspects of your transaction, from structuring and diligence to financing and securities compliance. They also represent stakeholders throughout the ecosystem: capital providers, lenders, family offices, sellers, management teams, which gives them a unique 360-degree perspective on the sponsor model that ensures a seamless process for your transaction. Partner with Platt Richmond to focus on what you do best: finding and executing great deals. Visit plattrichmond.com today to learn more. That's Platt with 2 T's, Platt, Richmond.com.
By the way, Drew, the investments that you've made, the acquisitions that you've made, have your investors, how would you characterize their involvement in all of the acquisitions that you've done? Have they all been in all of them, or have none been in any of them, or something in between?
Yeah, they've been in all of our deals, but it's kind of think of it, this part of it, as a pledge fund for them, right? And the economics, they've already kind of contributed, right, with the seed capital, but family offices, every year is a different year, right? So capacity may be strong in one year and less the next year. So
yeah,
it's moved up and down between those investors, and they've also brought their own friends and family investors as well into all of our transactions, which has helped. But the one thing that I think is one of our core competencies that we always try to do before we actually move in and acquire a company is build that advisory board, board of directors, whatever you want to call it, of people that have been in the industry, know the industry, of operators that can tell us inside out, the strategic moves to make with the company we're looking at. And we've done that with all of our portfolio companies. And they put capital in as well, and we incentivize them on the upside as well. So that's how we got into the fire protection space. One of our operators worked for Johnson Controls for a while, really pumped us up on the space. And to me, and Sam and I, it was new. So it was a great way to really understand the thought process behind somebody who's operated in the space. And I think that's something really important for us that we've continued to do on every deal we look at, is bring in operators. Or, the best thing that I like to find is executives that, were in this industry for 30, 40 years, retired, but want to get back in the game and want to get back in the game to, usually what we're always doing is bringing in a new operator, a GM or president, to replace the founder who's going to retire. And then you bring in the person like that I just mentioned that can help mentor this person. And it brings up a great relationship to start something new that way.
And how do you compel executives like that to join you? What do you give them and when?
So usually it's participation on the upside. So it's almost like they get their own piece of carry is usually what we do. And it'll be, post-close, I'll share a document like that, as we're going through diligence. And I like to do this even before we submit an LOI. A lot of the times that, when I say, we focus on this region, it allows me to find opportunities, allows people to remember Drew likes Maine deals in the Northeast, but bringing in people like I just mentioned, industry veterans early on, helps me win the deal versus just find the deal, right? So, they'll be in early on, and then I'll share kind of how the economics would work. This is what it could mean. And then usually it's something like that is signed, within the first month or two, and we leave room for more people to come in, down the life cycle investment.
But Drew, in the fire protection case, you happened to meet an executive who turned you on to the industry, got you excited about the industry. But I would imagine generally what it is you develop a thesis about an industry and then go out looking for a veteran and try to recruit him in. What's the sequence there?
Yeah, I wish it's kind of both. I wish it was like that, but I'm not lucky enough to find, hey, this industry is super awesome. I love this one for these reasons. And then I'm not able to find something immediately that hits that. Usually it's the other way around. It comes in the funnel, and then I learn about something, and then I'm like, maybe this is interesting. I've never even heard of this, like certain niche right here. And then I go out to find somebody. It's 50-50. So it's never one or the other, a certain order of operations, but I can't control what comes in the door. And so
by coming in the door, you mean a deal comes across your desk that's running a process. Yeah. So these are not proprietary, obviously. You're seeing something that's being banked, and then you take a look at it, and then you get excited about it, and then you try to find an executive, veterans from the industry you can talk to.
Right. When the proprietary ones do come in, obviously I'm all over those, but they're not that frequent. That's right. That's the special sauce. But when they do, that's the best, the stars of all line. Proprietary industry I want to be in, expert. That's the best thing I could get.
Speaking of proprietary, Drew, I would think that being the guy in Maine, the business buyer in Maine, that one of the things you'd really hope for is that would generate a proprietary deal flow. That through the business networks of the Northeast and Maine, there's this guy Drew who looks at businesses in the lower middle market up here. Have you found that to play out yet, or still early, or what?
It the what showed up the most, and this is Maine and New Hampshire more specifically, is being a local investor, boots on the ground. We have a network here, and it allows me to get an angle to win a process. The proprietary stuff does come up, but it's infrequent, as I mentioned before. But Mainers like to sell to Mainers, and
Yeah.
same thing in New Hampshire. So I think we will, let's just say price is generally the same. That'll be an edge that could help us speed out, competition. The stuff that we're looking at is not, 20 people bidding. It's 2 to 3 of EBITDA, local type business, family run, and maybe there's 2 or 3 other real bidders in it.
Oh,
So this can be the angle that the other group bidding from Chicago won't have.
And when you say there are not as many bidders, is that because of the region? Is it somehow overlooked a little bit, do you feel?
Yeah, I mean, there's one right now I'm looking at. I have an LOI signed, and it's way upstate Maine. And I'm in Portland, Maine, and so it's a 3-hour drive for me to get up there. There's a lot of people that just won't bid on it because they're not going to, drive all the way up to Portland and then another 3 hours up there. I mean, it's just being local does bring down. I mean, sorry, being where it is brings down the amount of people that are actually going to take it seriously.
Yeah.
And we're not looking above 5 million of EBITDA, 1 to 5. So we stick to, founder-owned, family-run companies. So nothing that's owned by another fund. We won't look at that either. So, but yeah, it's not an overwhelming process really for us when we look at things that are brokered.
And I have to imagine in a state where there are 600,000 people, there's a lot of knowing some of the same people, and whenever you meet a seller, that you have a lot in common and a lot of ways to build mutual trust in each other.
Oh yeah, absolutely. There was another one in Yarmouth. That's a town that's that may come back around. That the owner had a lake house next to my family lake house up in Naples, Maine, on the lake. So we were like, oh, we're gonna have a closing dinner at the the restaurant over there. So yeah, there's a lot of commonality, and that helps.
But shouldn't other independent sponsors relocate from Boston up to a smaller area where they can be a big fish in a small pond?
It's a small pond, though. I mean, they might not find the deal they're looking for. I mean, I think when you're, let's just say in Boston, you got everything. You got so much stuff to look at, but you're looking at the same stuff everybody else is looking at. So, I mean, I do think if an independent sponsor wants to operate and invest in somewhere, and there's a place they want to live, why not start there if you have the freedom? Because then you can build that angle.
How does it make you feel when you hear about the lower middle market deals happening in Maine that you're not involved in?
It frustrates me when they close and I never got to look at it. That doesn't happen too often anymore. I feel like I always get a good look at something in when it's in Maine. But it's if I do hear it, it's usually someone I know, and it's how can I help? It's the best thing I can really do on things like that. And how did I miss this one would be the other one. Like I'd want to know. So it doesn't, I get a look next time.
No, I'm very intrigued by this geographical opportunity because we do not hear about it from the sponsors we meet from Dallas and New York. Naturally, there's overwhelming competition here. But from those who have gone after geographical plays, we had one sponsor on who said, yes, we only look at 2nd and 3rd tier cities, and this is where we have an edge. And with the sellers, we can connect. Very similar, I think, to your storyline here, not in the same geography. We had someone else who said it worked 20 years ago, but not so much today. Technology is there, information to information is much more available. And so the arbitrage you could get of just being willing to travel is gone. It's too crowded now. And so it is refreshing to hear that it's working for you. And I think actually outside the United States, in a lot of countries, most countries, frankly. The geographical element is, of course, huge because being, for instance, a buyer in Norway, there aren't that many sellers in Norway, and they greatly care about dealing with someone from Norway as just a corollary example there.
I think it's also, what type of companies are you looking to invest in? If what we're doing are companies that are a local company, their customers are in the Northeast, and the operation is only in the Northeast. So that's how our network can help boost these companies. We can find operators, we can open doors, we can find, value add boards and stuff like that. So it's just, I don't know. I found it the best way for my network to be useful for the portfolio we're building. And it first started when I was at my last role, and we were investing down in Florida, and I just started building a network down there, and the same thing started happening. We did a couple investments down in Florida, but Florida's, much bigger and kind of crazy down there in terms of the stuff you see, but and a lot more.
So Drew, of your 5, are they all in Maine or the Northeast of your 5 platforms?
So it's Maine, New Hampshire, Massachusetts, and then there's one that's based in New Hampshire too. But it's the most employees are all across the country. So CEOs, in New Hampshire, but yeah, that's 3 states so far. I haven't found one in Vermont yet. That's where I've been kind of looking, but we'll see.
Well, can we hear more about the fire protection deal? This is the one that's looking really good. You've already mentioned it. Maybe walk us through the whole story.
Yeah. So that was our first deal. We have a friend that, I was an advisor board right now. And as I mentioned, he got us pumped up about the industry, and really we drank the Kool-Aid he was giving us. And we found an opportunity of a process that was broken. And I actually had found it at my prior role. And when I was there, it didn't go anywhere. They found a buyer, and then that didn't go anywhere. And then a year went by, back on the market, 2 brothers that owned it. And there was, I had one advisor, and eventually I got another advisor involved to buy the company. It was just between $500,000 and $1 million of EBITDA. Two different locations. They didn't speak to each other. Everything is pen and paper. No management team at all. It was going to be and has been, a long haul investment in terms of being hands on too. There's one thing that it was helpful to have Matt, who was our advisor for this, and there's another individual too that kind of fit that category of retired executive that's now kind of mentoring our current CEO there. But the one thing we're looking back at it that I would say I would do differently is get more time with the 2 brothers than what we had. We had only 3 months, and 3 months to find an operator that is a good fit culturally and good fit, for exactly what is needed. I mean, without an infrastructure, this person needs to be really entrepreneurial and ability to build everything that the company has today. So, fortunately, we only had 3 months. My partner Sam and I ran the company for 3 months after that, and then our advisor actually brought in someone he mentored when he was at Johnson Controls, doing fire suppression there. And he was able to start towards the beginning of that, month 7. So, my partner Sam and I, we're not operators. We shouldn't be operating. We should be doing the kind of the back office upgrades that we can do, which we did do while we had that time. But this is a very code-driven industry that we needed that person. It just took a lot longer. So going forward, I usually always ask for at least a year with the sellers to make sure we find the right fit.
But it took you 7 months to find this person, and has that person been the one to grow the business since? And he's 5 years since.
Yep. And came also, which I didn't realize at the time, but came with an extremely impressive network to lure great talent to build the base underneath him. Long track record. Johnson Controls. They have a very big service segment, and a lot of people followed them, and built the team that we have today.
And was he based in Maine or the Northeast already?
Yes. Yeah, he was in New Hampshire. So one location was in New Hampshire. The other one was in Maine, or is still in Maine. Because
going back to the Maine focus, if you're thinking that you're going to buy it and bring in a new executive every time, that executive talent might not be available to you in Maine. And so then you have to think to yourself, where am I going to find that talent? And are they going to be willing to come to Maine? Probably Portland, Maine, yes, but maybe 3 hours north of Portland, a harder sell.
Exactly. You're absolutely right. That's the other risk that we have, limiting geography. The pool of applicants, if you want to call it that, or candidates that we're looking into is much smaller. It's got to be somebody that wants to live there, that has some sort of connection to New Hampshire or upstate Maine, and wants that type of lifestyle too. Obviously I think, COVID and people moving up there and staying up there, that kind of maybe increased the pool a little bit. But it's not as easy as finding somebody, hey, my company's, a half hour outside of Boston. That's much easier, but then you got to pay a lot more too.
And so with this person that you were happily able to recruit and has done a great job and brought people with them, you said, what has been your involvement over these last 5 years? Have you kind of stepped back once you had your 3 months of operation and then put him in? Or what does that look like? Your own involvement?
Yeah. It's like a weekly touch point. And it's been so. Probably in the last year, it's moved to, every other week. We brought on, and this is what we'll I've referred to before, like the retired executive. We brought on an individual that ran Kidde Fenwal, which is the biggest, fire alarm manufacturer back a while ago. And I actually connected through LinkedIn to him. He's a Cornell guy, so am I. And I just pinged him and said, "Hey, you interested in this?" And he's absolutely. And so he's been mentoring our CEO, and he's been great. And it's really taking a look at the strategic side of things. And there was a lot of operational stuff that needed to be done in the first year or two, but now it's been able to, where do we want to grow and what do we want to be 3 years from now, and thinking strategically. So this company started off in just fire suppression, which is a very smaller niche of the whole fire protection world. But most of the customers who are bigger corporations want the full wrap of product, meaning sprinkler and alarm. And so our goal was, and finally we got there, is to eventually build or acquire that to be able to provide the customer everything versus just the suppression side of things. So it's the strategic stuff, the M&A, and the kind of financial engineering part of this. There was never any real strong financial reporting function, budgeting, all that stuff had to do from scratch, which I'm sure a lot of people, know on when you're doing smaller deals. So, but smaller deals, so it needed a little more hand holding early on, and now we're at the strategic side, which is, when you invest bigger, it's where we'll continue to be.
And when you say hand holding, you also said that you were the operators here.
September to December of our first year of ownership. And it was, Sam would be at one location, I'd be at the other location. We, as soon as we could, we were like, it's all yours. We're out, so it was in our best interest to do that. Cause also it comes at the expense of us going out and finding our next deal. When we're operating, we're not doing what our GP wants, which is to go find the next deal.
Yeah. But it is a source of confidence for the GP when they can partner with an independent sponsor who at least have the chops to be able to go in and be an emergency solution when needed.
Yeah.
And when you say it's at the expense of doing our next deal, of course, your next platform, that's your expense as an independent sponsor. But I think in this case, you meant the next add-on, which is accretive to the investors' money as well.
Can you give us some numbers around performance or growth?
Yeah.
That business?
Yeah. I mean, we bought it, was, around 600-700 EBITDA. the end of this year will be just north of 2. We've made 2 acquisitions. One got us into the sprinkler side of things. That one's really tough to build organically, super competitive to get people. So you kind of need to acquire it. The alarm part, we built, we overhired, and I wouldn't say really overhired, but if you looked at our first year, it was a down year because we overhired, and then the revenue came thereafter. So in that year, we did have a dip because we had to bring on really good, talented fire alarm staff, but the revenue didn't come till a year later, and that went from 0 to now we're generating 3 to 4 million of alarm on, and that's straight greenfield. That's not an acquisition. So it's kind of a cool way to look at how you can get into different spaces. You can build it on your own, but you got to be patient, or you can buy it. But if you buy it, you got to pay up.
Can we talk more about how do you decide on M&A versus greenfielding? At what point does it make sense to greenfield, would you say?
When you have the network to do it. Our operator had the people lined up, the people that wanted to build a business. And when you have that, that's the keys to go greenfield. But, if you're like, I'm going to, sign up some headhunter and I'm not going to have an angle, and I don't have a location yet to put these guys, like that's where I would acquire it. So it's kind of comes back to your network, I feel, if you're going to build it.
Drew, 700,000 of EBITDA, or what we might call SDE at that level, seller discretionary earnings. That's a small platform.
Yep.
What was the entry multiple?
4 times.
4 times. And now it's above, or 2 million of EBITDA or above?
Yep, just above. Yeah.
And what do you think? I mean, we all know that fire is a hot category. What do you think it trades for?
If we get it to 3, it's going to be high single digits. I think with all the stuff that you want out of a company, diversified customer mix has that full wrap that I mentioned, is going to boost up that the appetite for this in the higher single digits. The question would be, when we do sell, what's that buyer going to do with this company after, and what I think it would be is, continue to expand, outside of New England, go further down south to maybe a little bit more in Connecticut. That's the part that, and the other part is where we've acquired and built fire and sprinkler is regionalized. So a new buyer could come in and spread that, sprinkler from Maine to everywhere else, or the alarm from New Hampshire to everywhere else, right? So building that story is going to be a big part to, new buyers coming in. And this is also like if they're looking at it from a platform perspective. If it's a consolidator, they kind of don't even really care. And there's a lot of those out there too.
And on that point, Drew, the consolidator angle, what inning would you say it's in? Because my impression is it's a pretty mature space in terms of consolidation, which is good for you.
Yeah. No, it's in the second half. It's the stretch right now. And that's, I see that by seeing the competition from the big boys at that level you just mentioned, 700,000, like they're coming down that low. To build, right? Because that means, what's available, at the size they can deploy more capital is just either not there anymore, but there's a lot, it's still fragmented when you get small, but when you get small, it comes with the risks of a small company and stuff. So maybe that kind of leads me to believe that, we're probably in the 7th, 8th inning when all the little guys are getting bought up.
I'm sitting here and listening to you map out what the exit could look like for this platform where you've tripled EBITDA. How integrated has a sell-side advisor been for you in this mapping process? And when and how do you recommend involving a third party to help advise you through an exit process?
We're very early on that, right? If we're looking at a sale, towards the second half of next year, we've only reached out and had conversations with a handful that have done something like this in the space, and then also done it on the smaller end, sub 5 million EBITDA. And it was more confirming what we already know to be true as to what a buyer is going to be looking for. And so we're steering it in that direction, and then probably sometime next year we'll select the one we'll go with, and then they'll be doing a lot more of the work from that point on.
I mean, you say we've only talked to a handful of bankers, but the amount of value you can get from talking to 5 bankers on a topic like this, I should say, about what are buyers looking for, what kind of multiples are going right now, it must be incredible.
Yep.
And so does that then become a dialogue and a two-way conversation from that point onward?
We'll probably re-engage most of them towards the end of this year, when we can look back as to, okay, what did we do this year? How did the integrations go? We're about to close on another transaction the end of next month. How did that go? Yeah, I mean, that's top of mind. And, we have annual reviews or annual meetings with all our LPs. And so this time last year, we were saying, hey, this is our 5th year. So we're going to be looking to move in the direction of an exit. And that really just started this year with those initial meetings and conversations that we've had with bankers.
When you say you have an annual review with your LPs, this is interesting because most independent sponsors have a different or not totally overlapping set of LPs for each deal. And that may also be true for you, but you also have your GP level LP. So what's the format of that, and what exactly do you report to the LPs on an annual basis? Do you talk about the whole portfolio since they're presumably in every single deal, or how does that go?
So our 5 GPs have a separate one where they look at the whole portfolio. What I was referring to is, fire protection specific. In those LPs, we have annual meetings where we discuss how the year went, what the next year is going to look like normal private equity would do. And exit is always kind of up there. And so that was the discussion last time. And so we do that with all our portcos, and all our GPs in all of them, but the rest is it's different across for each one. So it's separate conversations.
Drew, we only have you for another couple minutes, but in that time, can we hear about the service disabled veteran? What is the acronym or the abbreviation? Veteran Service Disabled.
Yep, it's a SDVOSB, Service Disabled Veteran Owned Small Business.
Yeah, there it is. If you're in that world, it eventually it flows off the tongue naturally. But if you're not, it's always a struggle. So you bought one of such a business. Tell us about that, and of course that angle to it, and how you worked around that or worked with that.
Mm-hmm. Yeah, I mean, this always goes back to networking and how that can help you in opportunities like this. And an SDVOSB company needs to be owned by a veteran to retain those contracts, and that's exactly the case with this company that we're looking at. And one of our advisors on another portfolio company is a service disabled veteran, had capital he wanted to put to work and wanted to buy a company in the Northeast. And so when this opportunity came along, I understood that, well, there's no way North Haven can own control of this company, but we could own minority. We have flexible backing to do that. Flexible backing that also knows our advisor from another portfolio company, and kind of merge the two into being able to purchase this company, which there's a limited universe of people that can buy it. There's obviously a disabled veteran that has a bunch of money can do it, but there's not a lot of those really. And so, we closed on that last year. And it's been a great investment. And there has to be a good trust factor in there. And we had that with already working with this individual who now runs the company and owns 51%, through spending time with him on another portfolio company.
So the rule is 51%.
Operational control, highest paid employee. Those are the ones.
Gotcha. And but they don't have to bring all of the capital.
Well, they have
in this case, he had some capital to contribute to the deal, but he doesn't. What does that look like, the cap table?
Yeah, I mean, he was able to come with enough capital to be 51%. This was, these companies don't sell for high multiples for the exact reason we're discussing, right? And so, we found a mezzanine group that was interested in making this happen. And so with modest amount of leverage and, below 4 times, multiple, wasn't a lot of equity to really put in to buy 100% of this company. So it worked out.
And what was the EBITDA of the business?
Close was 3 and change, 3.2, something like that. And
what did it trade
this
for?
year? Off the top of my head, it's multiple between 3 and 4 times.
Wow.
Yeah,
that's really a low multiple, as you said.
Well, there's structure to it as well. That will be paid out over time. Things go well. So we put some structure in it. So, there's upside that can be earned, by the seller.
Yeah.
So
because the demand for these businesses is softer because of all the attendant requirements of the veteran angle, how do you then think about exit?
This wasn't modeled as I'm selling to somebody exit. Since the purchase price is so low, there's the ability to get our capital back, by the end of the second year. So those are the LPs that were interested in this. Get your money back in 2 years and you're owning 49% of $4 million of EBITDA. I'll do that every day. But it's just kind of rare to have, high level of earnings and low level of multiple to be able to do that. And that kind of rarity of buyers for this made that happen too.
Well, yeah, and your buyer. And now, but you could have structured it in some way where even if your buyer, your partner, the veteran who's now running the business, didn't have to have all 51%, but would have still had 51% on the other side of the transaction, right?
Yeah, but the government would not look at it that way. They would look at, let's just say it was, you're putting this in, but you could get 51%. They look at exactly what it is at close, what the closing capital table is dollar for dollar. So, there was a lot of different structures we looked into, and we, paid a good amount of money to some DC-based law firm to, poke holes in our ideas, and they poked holes in basically all of them and said, none of those are going to work. You're going to regret this, and just stick to the book and, 51, 49, and don't play games, because the government's not playing games either. But, I do think this is a space that's worth attention, because, veteran-owned businesses are either going to do something like this, or close the doors, or sell to an employee. And usually employees don't have the capital to do it, or an ESOP or something like that. ESOP wouldn't even be veteran owned, but there's a finite amount of these type of businesses, and the budget that's allocated to these businesses from the government is growing. So you kind of have a conundrum here of these businesses either going away and the budget to fund them from the government going up.
But Drew, just to napkin math this, tell me where I'm getting this wrong. You said it was 3 million, 3.5 of EBITDA,
mm-hmm.
and you bought it for between 3 and 4. So call it 3 to be conservative. So say you bought it for $10 million,
mm-hmm.
Light leverage.
Yeah, no, the leverage was light, meaning multiple EBITDA, right? So 2 times would be 6. It was between 2 and 3 times. So, let's just say it's 7. The equity was 3.
He had $1.5 million of, okay.
Yep.
Yeah. And he was willing to just part with pure liquid cash. Yeah.
Yep.
It's not just a rare veteran, it's a rare person. I mean, there are a lot of people who have that amount of money, but it's a rare person who has that money and is then going to go be the operator, going back to why it trades for so low and why it's a great opportunity.
But for veterans who have some liquidity, wow, what a great opportunity. They are, the only ones who can position themselves to afford buying 51% of these type of businesses. And to your point, Drew, there are some great tailwinds in the space with more and more of these businesses and more funding, but very limited exit options.
Yep. So that lends itself to the low multiple, right?
But going back to the three criteria, you mentioned operational control, highest paid employee, and majority control, 51% or more. If you were an independent sponsor and service disabled, let's just imagine, and you had some liquidity, would you be able to build a portfolio where you own 51% of three different companies at the same time? Or does that not fulfill the criteria any longer because you can't be the employee of three different companies? Or would that be overlooked? Would nobody really know that, oh, he's a W-2 but doesn't really do anything? Or...
Yeah, here's the other criteria. You full-time, you have to be full-time.
Okay. Yeah.
So my guess, you can't be full-time at three companies, and the government's like, yeah, cool. Yeah. And they have to own it directly. They can't have it as a portfolio. Right. They have to be direct owners in it. It's not even through like a trust or anything. You got to be, exactly. Yeah.
Well, congratulations on your success building North Haven. We will be eager to hear about and keep our fingers crossed for you for your exit. And of course, we hope that for your future opportunities, you keep us in mind and send them our way to maybe participate at Minds Capital. Thanks for coming on the podcast.
Great. I appreciate it, everybody. Thanks, Will and Nicholas. Appreciate it. Pleasure talking to you guys.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.